Hello, everyone. Welcome back. We're in module 3 today.
This is module 2, video 3.
Video 3. Okay. All right. So what we're talking about is hotel deals and how to analyze this. Now I'm going a little bit of detail today and break down some of these sales in this spreadsheet. But when you finally get it, it'll be much simplified version. Kind of one liner so you can spread through, because everything is going to be based off percentages on what it projected to do. But there's a couple things that, like I said, you need to know, like we talked about the ADR, average daily rate, the occupancy rate, and your RevPAR. Those are the key main things. But on the spreadsheet, your big thing is what you see here. You need to know your number of rooms, what your projected occupancy and ADR, and as you see, it will populate the entire spreadsheet. So on this particular one, you'll see that we put in the number of rooms. This is actually a Courtyard hotel in Worthington that we purchased. When we looked at it, the rate was actually it was more like they said it was projected at 57, but by the time we closed, this thing was actually operating at 55%. But I'm gonna show you something here. So what that means is you'll see this number adjust. Everything's going to adjust once we populate it. And as you can see, the bottom line is going to adjust too. Sorry about that. Right here. This is your NOI before debt. Here's reserves, and then here's the EBITDA, earnings before income, taxes, depreciation, and the amortization schedule, which means money you make before you pay out anything else, right? I don't know why it's got EBITDA taxes.
Yeah, before income taxes.
Oh, income taxes. Yeah, okay. Brain freeze. Okay, so in this particular one, so you saw that it said it was doing 900, but in actuality, when we bought it, it was actually operating at 54% occupancy, and the rate was more like average of 104. And we started seeing numbers change. And so remember, before we started, it adjusted. I don't know how much. It adjusted a little bit. And so this is the big thing. The EBITDA is 943 and the NOI is 797. So the big thing is here is what we like to look at in apartments. We want to really look at this gross operating profit. Bless you. The 39% gross operating profit. In the hotel business and the groups we work with, we feel that we can operate at a 45% gross op profit. As you see, it's projected to do that. And then here, the NOI is in the low 20s. We like to be in the mid 30s, all right? And you see how this is pretty low. So, but in this, our goal was moving from 54 to 60%, and then 63%. And it's simple populating it. So, you can say 58%. And see how the gross adjusted down here, the room revenue adjusted, and here, remember 35, 69. So we'll put it back at 60%. Remember 35, 69. Now it increased by almost 100,000, right? So 2% does make a difference. And also the big difference is we believe in the first year we'll get it to $109 a night. All right, and watch the revenue change again. Watch these lines change again. Even more revenue. All right, and the RevPAR adjusted. Now, so those are big things. So the big thing is pushing the occupancy, pushing ADR, and as you saw, the revenue changed. Our goal was to get this to gross about 4.2 million a year. And it looks like we can hit that by year 5, only being at a 63% occupancy. Now, there's also another STAR report that we talked about earlier showing what the rest of the market is doing. And the rest of the market showed that it was doing a little better. So that's why we felt we could push it very conservatively to 63%. But now we also taught you about, we talked about ADR occupancy, but the key thing right here is the number of rooms, because that's going to populate your entire spreadsheet. So you look at rooms available. You're like, wait a minute, I thought you only had 145 keys. They don't talk about doors, they talk about keys in hotels. And so you do, but it's 145 rooms over 365 days. And so that's how you get to 52,925. And you only occupy 30,360 rooms at that period of time, which was at a 54% occupancy. Now, also on the spreadsheet, this TTM 818. This is the trailing 12 months from up to August 2018. Okay, and so the bottom line, we wanted to get this thing up over 4 million, and at 4 million, that means we'll have an NOI of about 1,000,000, which is where we were working to get to by year 5. This is year 5 here, right? 1, 2, 3, 4, 5. But it looks like we get in year 6. We're still at the 27% NOI, but we still want to push that number. But as you saw, the gross operating profit is where it is. So this is why we felt we could push these numbers even more, is by pushing this gross operating profit. And once we do that, we can continue to do that. And we were able to do that also through other numbers. But here, now in our particular one, you see the taxes increasing. That's because we were using a PACE mechanism included in there. But that's another story. So the bottom line, our goal in these hotels and these smaller ones, we want to get to a 1.2 NOI before debt. All right, yeah, and you'll see that here. So right here on this spreadsheet, which is our hotel, but then it goes into a pro forma, and it's the clean one. And as you can see, it has a clean version of everything, right? And so on here, this is the trailing 12 when they ran it. Again, this is year 1, 2, 3, 4, 5, all the way 10 when we project it. And then in this, naturally, you got all the expenses, department revenue, food and beverage. And that's one of your big costs there. And what you want to do is increase that, as we showed you here.
What's telecommunication?
Telecommunication, they actually got different phone service, different systems you need to pay for people to use. All right. Then there's the department expenses. That's the revenue, and then what it costs to run the food and beverage and IT, et cetera. And then you got the house expenses, the utilities for the rooms and the entire building, what we spend in marketing, maintenance fee to maintain the building, franchise fee. There's in that franchise fee, there's also the royalty fees that you have to pay the brands for utilizing their brands. Okay. And then again, you got the gross operating profit. And then the reason why they have gross operating profit here, because when depending on your location and what building, these costs here fluctuate per building. They're variable, although they're fixed costs, but they're variable from property, right? So every property, the insurance may be aligned, a certain price per key, but if you have 100 units versus 144, well, that price is going to adjust. The management fee, that's a flat 3% or 4%, but your tax expense is what adjusts. And so in order to compare apples to apples, the hotel industry likes to use the gross operating profit to determine how efficient that the property is running.
Mhm.
Now, there's nothing wrong with operating at 30%, 35% gross op profit, but it will affect your bottom line. But we know when a gross operating profit building or a hotel is operating below 30 or 32%, then we know it's not performing well. All right. So that's that. So,
What about the FFE?
oh, FFE, that's furnitures, fixtures, and equipment. So this
Mhm.
is the reserve. This is what you put away for your rainy day. No matter if it's a hotel or apartment, you're required to put like 4%
Mhm.
away of the gross.
Mm.
And so you'll see that we do that every year because what happens, not only, you know, you got to serve for operations and other things like that, you know, you'll have a rainy day where you don't expect to do well. So like in the hotel industry, depending on where you're at, you know, unless you're in a destination here, but for the majority of us in the hospitality industry, November starts to slow down, but still good. But December, January, and mid-February, you're slow. A lot of people run below 40% occupancy. If they're running above that, or you know, it's just people are not traveling. They're returning back, and business travel is slow, etc.
Mm.
And so with that, you know, you need money to perform because, like on this particular hotel, I believe our break-even point is 250 in revenue. But like in those winter months, it falls below 250, maybe 175, 225. So you got to have
250,000 for the month.
yes,
For the
you got to do 250,000 to break even.
Mm.
And if you fall below that, you know, you're running in negative, which is natural. But then at about mid-March, into March, I'm sorry, mid-February, beginning of March, that's when you continue to escalate. Your occupancy increase. You'll jump from like 40% to 70, and then April, May, it keeps getting higher and higher. And then like July, you know, May, June, July, you're in 80, 90. You'll see multiple sold out nights. Okay. Also in the spreadsheet, you'll see the ADR inflation. This is the rate of escalation per year, expense increase, and the reserves. All right. Now, here's the big one. This is the IRR, internal rate of return levered, meaning you leveraged it with debt. And so we're going to show you here with all expenses what the income looks like with debt. And it breaks it all down. So I'm going to start here with this cell. You'll see the Courtyard Columbus, Worthington. You'll see the 145 rooms. You'll see the EBITDA. All this ties back to the Performa page. It's linked in there, which is 1.29 in the first year. And then we put away reserves. And then the NOI, as you see here, the NOI is 1,077,000. Then we have a loan at, oh, here you come down here. This is pretty good here. When you get to this page, you got to populate these. So here you plug in the interest rate, and here you put the term of the rate. You know, so we can change it to 20 years. You see how that adjusts? We could change this rate to 6%. All right, but on this particular deal, you see how the big difference is? At a 20-year term, 6%. This rate, the net NOI after reserves and debt interest shifted to 252. But on this particular deal, we made it sweet. We have a relationship with a bank. They gave us a rate at 475. Look at that. We went from 200 to 330. But look at this. They gave us a 25-year term. Look at that, 421. But what I didn't tell you, watch this. They gave us interest only for the first 2 years. So let's take so what that means is the interest only, we don't have to pay the principal. So let's delete that.
Equal this.
There. And then you delete that. Look at that. You went from 200 to net 600,000 to the good. Is that amazing? All right, so let's put those back in. And then look, we also include in here the debt coverage ratio, DSCR. So in the standard industry, banks want to have at least a 1.2, 1.3. If you anything above that, that means your project is doing good. So what this means is you're bringing in 64% more income than your debt.
Mhm.
So if you're at 1, you're at 100%. You're just breaking even.
Just making the bank rich, but not you.
Yes, he's paying the bill.
Yep.
The bank wants you, so 1 over 1.25 means you're making 25% more than what your debt service is. In this particular example, we're making 64% more than what the bank requires. All right. Now, how this spreadsheet works as well.
Then you also have the refinance.
Yeah, and then we got the refinance. I'll show you that later because this. But let me show you some key things in here. I'm gonna skip down here. Where is it at? Now here is where you got to plug in numbers. Don't worry about what you just saw earlier. Here are the assumptions here. So one thing is this is how the debt coverage ratio and everything else populates. We put in a purchase price of 7 million. We had so much in transaction costs, and the PIP/renovation is 5.3 million. So we have a total of 12.8 million we're going to be in this deal. So what happens is you just adjust here. We knew that we were going to get a loan. Well, initially, it started off at 70%. All right. So at 70% loan to value. Now on this deal, we were getting paid, so that stayed constant. But then that means we needed to raise money. So here, 1.5 or 8.4. You know what? Let me make this simpler. Let's take this out. Let's see if this works for us. Nope, that's not gonna do it. That's not what I want. We'll
You
do
want to
it.
combine that to 1.5 plus 8.
Yeah, let me see. Let me see this one here. Yeah. Okay,
Oh,
so
this is
okay, this is
constant.
what I want. Put 0 here. There you go. So what this means, out of 70%, the total equity required was 2.3 million. But look, if we put in 75%, we get a loan for 75%. Total equity required was 1.7. This what made this deal, made the deal sweet. And so what this does is breaks down price per room. So now you're in it for 48,000, door. You got 3,000 a door in cost. The PIP costs 36,000, which is kind of average. A renovation runs anywhere from 30 to 35, depending on how major the renovations, but 36 is a good number, 36,000. We're going to be all in this project for 88 a door. This is great. First of all, that's great. Because in order to build a new hotel, it costs you about anywhere from 125 to 150,000 a key. As you see here, we're in it for 88,276 dollars a key. All right. So I'm gonna go back up here. So as you can see, by me putting in the mortgage down below, put in the PIP, the total cost, this shows us the rate and the term, and then this shows us our interest payments and our principal payments. And this gives us our available cash flow for distribution. Does that make sense for you? If not, you'll just email us, okay? Then here I got a little sophisticated. I'm showing you what happens if we refinance. It should be refinanced in year 3.
DSCR refinance.
Yeah. This is one if we refinance in year 3 or sale. This is sale. And I'll show you a couple of them. But what happens, so we go over here in year 3, right? You'll see, now you was like, well, why didn't you see here it has 1.14 for the NOI. But remember, we talked about over here, the NOI, but you remember this is NOI after debt. Everything's based off the actual NOI, the EBITDA before your amortization, all right, or your debt service. So if you take this by 8 cap, that gave it a value of 13.
8.5.
Where?
8.5 cap.
Yeah, 8 cap, which is very conservative.
Mm-hmm.
It actually should sell at 8 at least, which gives you a value of 14.8.
14.2.
I'm sorry, 14.2. And so you minus the mortgage, you minus sales expenses, you have 4.8 million NOI, or net sale proceeds. All right. And here you see over here, this is your projected return. So right now, this project equity multiplier gives you a 4.19, meaning on your 1.7 million investment, your money came back 4 times. And that's inclusive of all the cash flow that you received over that period of time. Okay. Now this particular one is showing 5 years. But this thing could do a particularly 4.19 equity multiplier. And then it has an internal rate of return without the preferred, meaning no debt distributions to investors, just profit distribution to project as a whole. It has a 42.48% IRR. It does a 28% cash on cash. That's an amazing deal. First of all, something to hit 28%, you jump on it. Because most people are only looking for 12, 14, but this is the kind of deals we do. And so what is a projected IRR of 42%? That means based on cash returns, inclusive of net proceed versus time value money, at a discounted rate, it would be the average of making 42% on your money over a period of time. Does that make sense? Okay.
And that's for the project.
That's for the project. Now my spreadsheet even breaks out what potential investors can get. So let's say the sponsor just did the deal himself, right? We put 1.7 in the deal, and we paid out a 9% pref. 9% is kind of like a debt payment or a coupon. Now, one thing about prefs, some people are not clear, but prefs are basically a preferred distribution. And what that means, you kind of clip in a coupon, but if the money's not there due to renovations or whatsoever reason be, you don't pay that out. But what
It's accumulated.
Yeah, and if they don't pay, it accumulates. Meaning, let's say the first year you were responsible for paying out $100,000 in preferreds, right? And for whatever reason, during that year, because you're on the renovation, you couldn't pay it out. So what happens the following year, you're going to owe $100,000 in preferreds, and in addition, you owe the money from last year. So it'll accumulate, or it can go to the balance. So if it accumulates, go to the balance. So let's say you invested 1.7, and now the 9% preferred is based on the 1.7. So 9% of 1.7 is 153. But if you didn't make any payments out in this example, then that 153, that 1.7 is now 1,853,000. And then you're going to pay 9% based on that. Does that make sense? And then the GP takes 70% of the deal. So not only do we get a pref, then because we put up the money, then it was 70% of the deal of the net cash flow after the pref, which you see right here. So the net income or net cash flow after debt was 421, then minus the pref. There's 268,000 to distribute. 70% belongs to the GP, the sponsor. So they received $187,000. So with the pref of 153 and their distribution, they received $340,000 in that year, which comes out to be a 20% cash on cash.
That's for the sponsor.
That's what it's sponsored. But that's because how we adjusted this. Now let's go back here and let's say the sponsor or the group put in, the investor, the crowdfunder, put in $1.5 million. All right, so now then the GP only had to put $200 in. So now let's look at their return now. Well, that's sick. Okay.
100%.
Yeah,
because you have less money in the deal. Right?
Exactly, because thank you, Glenn. The less money in the deal. But look, but you know, they put everything together. But the investor, look at him. They got 1.5. They get a 2.4 equity multiplier, meaning at the end of this deal, they're going to get 100% of their money back.
Plus 142%.
Well, plus 40%. Well, let's try. So this is a little weird.
Yeah.
So when you do equity multiplier and when you hit 2, that means you doubled your money.
Right.
And then anything above that means you got 42% more. But if you got 3, you tripled your money. 3.42, you tripled 0.42%. Well, tripled it, and with 300, basically it's a 342% return. Okay, so here the cash on cash is 15%. That's amazing. Make it 15% cash on cash, and you know what they're doing? These investors, nothing. They're just collecting a check every month. The mailbox money.
Yeah.
And investors, they can't find this anywhere. I mean, yeah, they may, but that's why they invest. All right. So yeah, this spreadsheet is amazing. But when we're ready for you to receive the spreadsheet, it'll be much more simplified version. Well, we'll be working on numbers as well. And then here, you'll see they get the preferred, and then at the end of the year, the 5 years, you see when we sell it. Yep, you see we sold it. So they got that 1.5. They still got their regular cash flow distribution check, and then here's their portion. Oops, sorry about that. Here's their portion of the net sale proceeds, right? So in year 5, they've received a total of 2.7 million. And if you include all this cash flow, that's how you came up with the 2.42 equity multiplier. And then they got a 23.39 internal rate of return. So amazing deal. And so in deals, investors are looking for these middle things. They want to at least see 8 to 10% cash on cash return. And then they want to see like a mid to high teen internal rate of return. But as you can see, we surpassed that. The mid-teen would be like 15% internal rate return. We're up here at 20%. They want to see at least doubling in money. Well, we did not only that, but we pushed it by 42%. And then we went over double-digit returns. Okay, great deal. Let's now that's a deal we did. It actually was performing worse than that. Well, you saw the trailing 12 months. It was actually performing worse than that, but we saw we could push the numbers, and so we pushed the numbers from a 54% occupancy to over 61%, and we haven't even done the renovations yet. All right, so let's look at a deal now that we're analyzing now.
What you're looking at right now.
Yeah, we're looking at a Hilton Garden Inn in Independence, Missouri.
This one.
Yep, here we go. So
When
we
you
go
look at
back.
the
Yeah,
okay.
yeah, you can go back. Actually, we can go to Performa because we already went through this. Okay. Now, what you see here is this has 200 rooms, as you see here, right? And then currently the occupancy is at 66% with an average rate of 98.81 ADR. It's grossing 4.8. Well, it's actually doing 5.3 million in revenue. And As you see, as I talked about before, we like to see our hotels in the 40s gross operating profit. This is actually at 36% operating profit. And so we're going to buy this thing, and by the time it's all said and done after reserve, it has a 1.3 NOI before debt. Now, that's great. It would be even greater if we didn't have to do a PIP. But naturally, doing the renovations, that's what helps you, your market, that's what helps you increase your ADR, that's what helps increase your gross operating profit, and you increase your occupancy. And so the goal on this is, because we knew this was lower, we knew we'd get to 45. So what that means is, if it's at 1.4, and we just make 5% in adjustments, we can create at minimum $2.5 to $5 million in value. And the big play was, how can we get this from 1.4 to $2 million NOI, which creates almost 600,000 more in net cash flow and income, and 600,000. What is that at an 8 cap? Yeah.
Multiplied by 12.5, so about 7.2 million.
Yeah, that's right.
Yeah.
That's 7.275 million added value. All right. So here we go.
Yeah, 7.5. You're right.
Yep. Thanks. So here we're very conservative. We just kept it at a 67, slowly increasing, and actually we kept it at 69, and we kept the ADR at 100. And so over a 5-year period, we felt we can get this to a $2 million deal. And I'm gonna show you numbers of what that looks like at when we get the loan in place. So far so good. I mean, $2 million. That's a great number, and we could be all in this for 17, 19 million. But understand, I've looked at multiple deals where they got to $2 million NOI, and the reason I knew it was good because they were selling the property at 26 to 28 million and sold them. So naturally, I was like, whoa, if we can get this to 2 million NOI, we can do the same. All right.
Even at a lower all-in.
Yep.
Yeah.
Lower. So in this particular deal, let's go down to our sheets where we need to make adjustments. One of the first things is, so they were offering this deal a while ago at 18 million. We kept passing, and so they finally came back and we were able to acquire 12.5 million. So we got that right there. We got transaction costs 18. That's what's included in the transaction costs. You got 1.5% acquisition fee. You got 100,000 set up operating costs. When you first start, when you take over, you need some reserves for that. You got legal fees, which can cost $30,000, $50,000. You got points for the loan, which is like 1 point, and 1 point of 200,000. I mean, what's that? I mean, 10 million. That's 200,000 roughly.
1 point of 10
I mean,
million.
10, that's 100-something thousand.
Yeah.
So all that's included in the transaction costs. Construction management. Naturally, if we have to bring somebody in and manage construction, naturally we have to get paid. So there's a markup. That's typically 5% of the gross. And then there's a PIP estimated at $6 million in renovation, which puts us at a total of 19.6 million. And so we've been offering a deal. There's one deal that we like now, but it's conservative. We think we can do better than that. Right now, there's a bank willing to lend us 75% loan to value, and all we have to do is bring in 25%, $4.9 million. And I know you're like, well, these are great numbers. Well, how do you bring up 4.9 million? That's another class. Let's just stick with the.
That's module number 4.
Yeah, let's work with this right now.
How to find investors.
All right. So once we plug that in, this particular group, actually, we're talking about initially 6%, but now when the rates dropped, we went down to actually 5.5%. And then, as you see, the first 3 years they offered us interest only. Look what that does to our numbers here. Isn't that amazing? We potentially can net $1 million. And here's the great thing: when we renovate, typically there's a slight disruption during the renovation process. But now that we got this renovation here, and it's such a big unit, we could shut a floor down and not even interrupt the flow of business. And so that's just, can you imagine yourself making $1 million a year? I do it every day. I imagine, and then next thing you know, it's happening. All right, nothing different. And look at this. Remember, I told you the debt coverage ratio should be at least a 1.25. Look at these numbers. It's ridiculous. We're clearly past that. And so what this looks like in return. So now, I mean, yes, we're all happy with these numbers, right? But what does that look like for our total investors? Okay, so here's the total project deal. I'll scoot it over a little bit. All right, so the initial investment is 4.9. The cash on cash for the average deal is 21.47. You know, first year 19, 21. I mean,
That's crazy.
Killer deal. This is if we did the internal rate in 3 years, but we went off to 5 years. Overall, our project has an internal rate return of 25.02%, which is great. All right. We like to get the projects up better, though. Actually, we like to see them at 30%. But you know, you got to take in the balance of the cash flow. Here we go. Here we're gonna break down the analysis with the preferreds and without the preferreds. This particular deal has a 2.38 equity multiplier. Without paying the preferreds, you know, it has this 25%, and then with the preferreds includes then you know, the project has a 12.47% cash on cash and a 16% internal rate of return, with the overall net proceeds of $6.4 million that will be distributed to investors. So what does that look like for the sponsor? Well, the sponsor will look like they will, after this, the first 2-3 years, they would net $347,000 to $500,000 a year. What does that break down to a month? 180.
So like almost, well, the first year is almost 30,000.
Yeah.
The second year is almost
40, 50,000 net to the sponsor team that they split up. And in year 5, they split 4.4, almost $4.5 million. So naturally, it looks good for the sponsor. What does it look like for the investor? Well, hey, they got their preferred. They hit their goal of getting their 9%. They received 30% of the distributions. And look at this. They hit above their mid-teens. They got an 18.17. They got a 2%, 2.03 equity multiplier, meaning they got 100%, 103% return on their money. And they still got a 12.74 cash on cash. Now, was this deal better than the Courtyard? Well, as far as numbers wise, no, you know, but cash wise, we're dealing with bigger money here. And so now you got to figure out, where can you go to put money in a deal, not work hard, and get great returns.
Yeah, not work at all.
Yeah. And so if there's something that you can do that's much easier than this, then you do it.
Right.
But in my opinion, there's not much we can do easier than this, so that's why we do it. And quite frankly, what we discovered, we're still in our due diligence process. But here's the thing. I showed you earlier, let me go back to the pro forma. I told you that the occupancy rate is at about 67, 68%, and the average daily rate is 100, and it gets to 104, 106. What we discovered, though, there's a local Courtyard that would really be equivalent to this one. So what happens in the STAR report, they take in all the numbers of all the hotels, whether they, you know, very comparable or not. So there was a Comfort Inn, a Wingate, and a Best Western. Now, I'm not knocking any of those, but those are not top tier brands. So naturally, their rates are going to be lower. So which that does is pull the whole comp set down as far as the average. So now this is a Hilton Garden Inn, the only really full service branded loyalty brand in that area. So you wouldn't compare Wingate or what was the other brand? Wingate or a Best Western to this Hilton Garden Inn. And you really want to compare it to a Marriott Courtyard, but that's the only one that's really equivalent. So, and typically a Hilton Garden Inn will outperform a Marriott Courtyard. Well, what we discovered is the Marriott Courtyard in that area, not too far away, is actually working at $120 ADR and a 70%
occupancy.
Yeah, so let's change that. Let's see what that looks like. So you saw 5.4, 5.7, right? And then at a 1.7, 1.8. What does it look like? Can I do it here? I think I got to do it in the other slide. Yeah, I got to do it in the other slide. What does it look like if we did do what that the other one did, the 70%. Courtyard? So yeah, 70% with 110 ADR, and then we'll leave that there as well and watch everything else. Yeah, man, we should that should be about right. And then here, 70%. Will they all populate? There we go. All right, watch these numbers. Look at that. 2 million in the first year. 2.1, 2.2, 2.3. When you start doing numbers like that, that's when you don't sell. Let's look what that does for the investor. Because remember, the investor was like about an 18.25 internal rate of return with a 12.74 cash on cash, with a 2.03 equity multiplier. Let's see what happens to the investor now. Look at that. They now jump over into 21%, 2.27 with 2% more cash on cash.
Nice.
That's how you win the game, by slight adjustments and really doing your due diligence.
Cool.
Hey, look, guys, thanks so much for joining. I'm sure you have more questions. And hey, that's why we have the other
funding summit.
Yeah, we got the funding summit. We have the coaching session as well, where you can ask all your questions in the Facebook group. So hey, don't feel free to ask, and look, watch as many times as you need. We'll go deeper into it. Thanks so much for joining us. Talk to you soon. All right.